Okay, warm welcome to everyone. Glad to have you all back at our Quantitative Investing Virtual Festival 2021. So glad to see all the support coming from you guys in terms of not only the number of signups, but also the number of repeated signups for multiple sessions, as I'm now already starting to see a number of you guys, your familiar names have been here with us since the very first session last Saturday. So very glad to have you all. We are happy to have received some very positive feedback from you guys as well, saying that the session was good and the content was excellent. And although the rest of our festival panelists, Bernard, Ingwan, and Patrick, they aren't here today, but I just want to say on behalf of them a big thank you to everyone, and that your positive feedback, it just means so much to us. Okay, so for the benefit or those for those who are here with us for the first time, let me just introduce myself again. I'm Da Wei. I'm running investment advisory at iFAST Global Markets. Time flies, and it's already my 4th year at iFAST. Previously, my background was in financial statistics. So if you're wondering why I'm in charge of the festival and the strategic contents that we are sharing, it is also because quant investing and quant finance does have that significant overlap in financial statistics. Right. And I'm also the main organizer for this event. Right. So glad to have all of you, and just to share with everyone how we have planned the content for this festival. Okay. For the very first session, we covered on the world of hedge funds, right? And to first give everyone a background understanding that hedge funds are by nature very much exclusive only to the higher net worth, right? And mainly to the accredited investors and the large financial institutions. And the thing about quant investing is that most of it is done privately only through hedge funds. And therefore the retail sector has by and large been very much underexposed to it. And on our second session on the 14th, right, Ingwan from All Quant, he also showcased that quant investing has achieved very good results over the years, right? So we have seen really how the best Renaissance Medallion Fund, how it has done, right? And although it has achieved really spectacular returns, right? Even before fees, we can see about 60 over 70%, and then we have after fees, because they have very heavy leverage fees. We do see that number going down, but it is still around 30% per annum. Right? And this fund is absolutely spectacular. Right? The thing about it is that just like many other funds, right, in the hedge fund space, it is closed off and only exclusive to its own private circle. Okay. So we know that today, the largest and the most successful funds in the world, they're actually quant funds. Right? And also because of the rise of fintech and the development of ETFs around the world, it is now very possible for us to be running our own quant strategies and to even replicate what some hedge funds are doing. Okay. So the festival is planned in a way such that before we go further on to the other days of the festival, to share with you guys on things like the all-weather strategy portfolio and how to trade in volatility. But today, I'm here to share with you guys something that is very important before you start running your strategies, right? And that is how to obtain clarity in investing. Okay, so many a times we always hear that the cause of bad investment decisions is because of emotions. And while this is true, like if you were here during our last session on how quant investing is different, you will understand that the whole philosophy behind quant investing lies in how every single decision can be traced back to science and math. Right? And therefore, the human emotional aspect is largely removed from our investment decisions. Okay. And definitely this is very effective for us human investors. But let me also pose to everyone a very real question. So let's say, for example, today we are running a quant strategy focusing on volatility. Right? And the aim is to profit off volatility spiking. And say another COVID-like incident happens, we don't wish for it, but let's say we do have something like this happening again, right? And that it causes your quant model to trigger you to buy volatility. Is it possible that because this COVID-like incident, when COVID started, right, nobody thought that it was going to go into a full global pandemic, right? We knew that there was a possibility, but no one knew for sure. Right? So is it possible that because of this COVID-like incident, still seeming small at the start, and maybe you find that the world, we already know how to deal with COVID, and we know how to have safe distancing measures, the government, maybe some governments, in order to downplay the economic impact, right, lets its media report that things are actually still in control and just fine, right? So is it possible that because of these conflicting information, you start to doubt whether you should actually follow what the model says and buy that volatility? Okay. So this is entirely possible. Okay. And there are really a lot of things that make us confused as investors, right? And conflicting opinions is just one of them. Right? And what's worse is that today we are living in an information age, right? So much so that it's more like information overload rather than an informative information age. Right? So how should we, as investors, deal with the situation that we are put in today? Right? But the truth is, a lot of the confusion behind what we feel is because we don't recognize some very basic yet very, very important things about investing. And even if we heard them before, we may not understand them deeply enough for us to be able to make good decisions in our investments. So for example, right, let's start with the first one. Okay, we know that the world's markets go up in the long run. Okay. So if you tell me that, Dawei, I already know this lah. I've seen this so many times. I've looked at the graph so many times. I know that it really does go up in the long run. I tell you, good, right? Good that you know. Right? But now my question to you is actually, why? Right? Why do the world's markets have to go up in the long run? Right? What is making it go up? This is very, very important to know. Right? As it is going to be so important in helping you when you see markets falling and your investment portfolio value fluctuating. Okay. And if you tell me that it is because of inflation, I'll tell you yes. Right, inflation is one of the causes behind the world's markets climbing. Right, but we also need to know that firstly, deflation is possible. Right, and secondly, the historical average of inflation is actually just about 2-3%. If we do take a shorter time period, right, it's actually lower, maybe about 1%. Right. So at the same time, the world's markets have actually climbed so much higher than this average rate of inflation, right? So why is it that the world's markets go up in the long run? Okay. For this, there are two reasons. Okay. Two reasons that we need to know and we really need to remember. Okay. So the first thing is longer life expectancy. Okay. We are living longer, right, which eventually leads to a larger population. Okay, so we are having more and more people in the world, but it is not because we are having more babies, right? It's because of medical advancement, right? And what a greater human population means is that there is increasing consumption, there's increasing production of goods and services, right? Which we can see from increasing GDPs across many countries in the world, right? And therefore increasing incomes, increasing company earnings, and eventually increasing company share value. Okay, so this is the first reason why our markets do climb in the long run. Okay, the second reason we wrote over here is the human spirit. Okay, so what do we mean by the human spirit? We are talking about the innate human desire to always make our lives better. And this leads to hard work, this leads to innovation, right? And this is also why we can see developing nations growing across the world and developed ones like the US constantly innovating for new technology, right? This is a very, very powerful reason. So don't belittle it, right? When not channeled well, it can actually lead to very, very grave impacts, right? One of which is actually the Japan's lost decade. Okay, so while markets come upwards in the long run, right, investing is all about navigating the ups and downs, right? And we don't say this trivially, right? Because we definitely want to avoid things like the Japan's lost decade. We don't want to be hit with things like the dot-com bubble, bubbles in China a few years back, right? And of course, the 2008 financial crisis. When markets are going up, definitely everyone is happy, right? We are all delighted to be earning money, right? And many times actually, maybe we don't think so much about our approach. We don't think so much about actually, is there anything that we need to consider and maybe some changes to be made, right? But the thing is, when markets are falling, what should we do? Right? Should we buy more at lower price, or should we be selling to cut loss, right? Or maybe a third option, right, which some of us might be pretty off at one point or another, right, is this, right? I'll wait to see what happens. And now I won't say that it's wrong to wait, but there's nothing wrong about waiting by itself. It's definitely worrying if we are waiting without a plan. Right? What we want to avoid is to not have a plan. So a lot of times, to navigate the markets, we need to have a very clear idea. Okay, this has happened. Right? I'll do this now. And if A happens, I'll do this. Right? If B happens, I'll do that. Okay. But at the same time, right, a lot of times we are confused, right, because we do get opposing action calls, opposing opinions. Right? So for those of us who might not be familiar, right, traditionally there are two ways to do investment analysis. Right? Firstly, through analyzing fundamentals, which focuses on a company or an industry's business prospects and long-term intrinsic value. And secondly, to look for patterns, right? And this is commonly called technical analysis. Right? So what happens if one approach tells us to buy and the other tells us to sell, right? And what if your quant model is to use both approaches? Which action should your quant model be reflecting? Okay. So the answer is actually both are correct. Okay, both are fine. And your quant model should be able to use both approaches without conflict. Right? And I'll explain the quant side in a bit. But first, in order for us to have that clarity in our investments, we need to first talk about how the fundamental and technical approaches each work. Okay, so let's start with fundamentals. Right? If you're invested before, right, you've probably thought about this in one point or another. Right? It's time, right, for you to maybe do a check, right, whether you have that deep and clear understanding. Okay, so how does fundamental analysis work? Right? There are two core principles that we have to keep in mind. Right? A lot of times when the market is falling, we see our investment taking a hit, and then suddenly we forget about these things. Right? Please remember this. Okay, so firstly, a company that earns more money is worth more. Okay, so very simple and definitely very common sense as well, right? And in case we haven't noticed, right? In case some of us haven't noticed, we are implicitly pointing towards company earnings and intrinsic stock price. Okay, so a company that has higher and higher company earnings should have increasing value and price over time. So that's one. Second one, right? Number two, this is extremely important. Right? Stock prices, right? We say that, okay, yes, the company is worth more over time, but will the stock prices actually really follow it, right? Because, you know, traders, investors, we can be emotional. Sometimes the stock market just doesn't make sense, right? So this is really something that we need to know and we need to take note of, okay? Fundamental investing, it works on a notion that price eventually moves towards reflecting its value. And value, of course, depends on how much money a company can earn, right? And if you don't believe this, right, you can actually see from many graphs, okay? So I've taken US and Singapore over here. Right? The red lines here reflect earnings, and the black lines reflect that average market stock price. Right? You can do this for US, Singapore, you can do this for many other countries. And this is not just the case for general markets, but also for sectors and down to single companies as well. Right? So if you do see some of these, right, on the left, we have the SOX index, right? This is actually the semiconductor index. And then on the right, we have TSMC. This is Taiwan Semiconductors Manufacturing, right? So you are able to see, right, that the yellow line here is EPS, or earnings per share, right, which reflects earnings, right? And then you have that share price in blue. Okay, so we can see, right, the notion of fundamental investing, it really eventually proves itself right. The key thing to take note for everyone here is actually, right, how long does it take before that price moves towards earnings? Okay, we do see a lot of volatility, right? And especially for Singapore over here. Right? So we need to really know and really understand this, right? That it takes time, right? And it takes usually about 3 to 5 years. And that's why you might always hear people say that investing is for the long term, right? Buy and hold is good, and when markets fall, buy the dip, right? This is what fundamental investing will tell you to do. Okay. On the other hand, right, we have technical analysis, right? And I must say I'm no tech analysis expert, but I can tell you this: okay, the core principles of TA are, firstly, right, established patterns can give you predictive ranges. And please do note, right, that many of the times seasoned technical analysis traders, they are going to tell you that they use predictive ranges more so than fixed target prices, right? So please do not confuse yourself and think that target prices are there for you to trade, right? There is a much better way to use target prices. Okay. And more often than not, target prices shared by institutions, commonly if you do go and read very deeply, right, what is being shared about in all these reports, is that a lot of times you're going to see things coming from fundamental analysis. Right? And so over here we have iFAST, right, talking about Xiaomi, right? And we do see the mentioning of earnings per share and PE ratio, which is price to earnings. So these are actually fundamental analysis, right? So we do need to be very clear, right? Let's not confuse this for some of the trades that we want to do. Okay. And then the second point about TA is very crucial for those of you who might have done some trading from time to time. You probably already know this, right? For those of you who have not tried this at all, right, this is actually so important for you to know, right? In technical analysis, profitability is the result of both your win rate and your risk to reward. Right? So what do I mean by this? Right? So let's have this scenario over here. Okay, we have John and we have Bill. Right? John has 80% of his trades profitable. Right? Bill has 20% of his trades profitable. Does that mean that John is more well off and a better trader than Bill over the long run? Right? The truth is, it's not definitely the case. Right? The key to technical analysis, a lot of times, right, is to have that strong allocation to trades, right, with high probability and high level of profitability. Right? You don't need to be right most of the time. Right? You can even have less than half of your trades being profitable. But as long as you have and you are able to catch that number of good trades, you can still do very well. Okay. So why do I highlight all these things today? Right? It's because many times we do see people, investors, right, being confused, right, when things don't go smoothly, and people do end up jumping in between the approaches, right? So please, right, do not do this, right? The consequences can be very, very poor. Okay. So for example, if we are investing with fundamentals, right? And then we confuse ourselves with technical triggers to cut loss. Right? Then I believe many of you would be somewhat familiar with this scenario. Okay, either you have seen your friends go through it before, or maybe you yourself have gone through it before, right? So when markets are falling, right, a lot of times this leads to impulsive selling, right? It is easy to sell and close our positions. The truth is anyone can do it, right? There is really nothing difficult at all about closing our positions because it does fit in line with our natural instinct to be more conservative when we sense danger. Okay, and selling is actually not really the problem. The problem is that there are no triggers to tell you when to buy back in. Right? Selling is easy to do. Buying back in at low price, that's not as easy. Okay, the problem is fundamental investing. But if you are going back to your fundamentals to think of how you should buy, how you should try to maybe average down at a lower price, right, you are not going to have that clear trigger from technical analysis, right? So this often leads to that sell low and buy high phenomenon, right, which of course leads to negative profits. Right? And also another, we can even say a disaster, right, that can happen, right, is we know that in technical analysis, right, we don't need a very high probability of profit for every single trade, right? So sometimes we do see some certain sharings online, right, and it tells us, maybe we can long this, right, maybe we can have a new position, hold it this way, right, and it goes without saying, right, that if our practice is to have a buy and hold, right, and it's something that we are not so into that common trading phenomenon, right, the common trading practice, then there is a very real chance you could be buying and holding a position that has a low probability of profit, right? And that is really not what you want to do. If you are a seasoned trader, you are very clear what you're doing, right? Definitely is fine, right? But if you are a little bit new, right, please do take note and don't let yourself fall into these positions. Okay. So depending on your approach, your inputs and what you consider in terms of your investing and eventually what final decision you make, they can be very, very different. Right? So do be very clear which you are using, right? And when you do get a little bit more experience in both, right, that's when you can try to combine both. Okay, so now that we understand the principles of fundamental and technical analysis, let's go to quant analysis. Right? For the benefit of those who weren't with us last session, right, quant investing basically means that we are using models to help digest data. And because of how powerful computers are today, nowadays quant investing often refers to using computers to help digest very, very large amounts of data. And why do you need this? Of course, is because in investing itself, there are so many companies, sectors, countries, situations, possibilities, right, angles to think about things. Right? So many of these for us to consider. Right? So what quant investing does is that we tell a model, okay, here are all the inputs I want to consider. Right? You are to process this information in this manner, right? And you are to process those information in that manner. Right? And then we have a goal in mind, which eventually leads to a decision. And I want to bring to everyone's attention, right, about the goal that we are talking about. Okay? Because the goal is actually the foundation behind why every quant model can work. Right? So for example, the goal can be to optimize for a good risk to return ratio, right, or Sharpe ratio in our portfolio. And perhaps your model can look to rebalance and optimize your allocations every month. Right? For those of you who might be familiar, this is actually a strategy run by hedge funds called risk parity. Okay. So what happens if we have two possible ways to base our investment decisions on, right, both of which lead to different courses of action. Right? here we come back to the philosophy of quant, right, whereby every decision we make can be explained by math and science. Right? So without quants, we may not be clear which approach to take. But what if I tell you that at least when you look at what could have happened throughout history, using one of these approaches has commonly led to a better risk-return ratio, and has also led to better results. Then would you not consider this a little bit more for your own investments? So that's where quant analysis comes in. You run a model, right, among different possibilities, and then you find out and see whether any of these are actually advantageous and workable for you. Okay, but why do quant models work? Right? Especially in the past, right, when we always say that the past might not reflect the future. And in our previous sessions, we did have a number of questions coming in about back testing, right? Asking about how reliable it is, right? And a lot of understandable concerns when it comes to talking about back tested results. Right? So to let everyone understand this, right, let me take you guys through the general process of creating a quant model. Okay, so previously we had one of the questions, right, from you guys asking whether humans would lose control over their quant models. Right? In other words, is it possible that quant investors, right, we just blindly follow a model and we do whatever we want, right? Whatever the quant model tells us to do, right, without thinking about things? Right? The answer is no. Okay? No, because right, the basic foundation, right, is always based off a logical reasoning that a human needs to analyze first. Right? The basic foundation of any quant model is a logical concept. Right? And right, so for example, right, it is logical to hunt for good risk-return ratios, right, because they reward us more for every level of risk taken. Okay, so therefore the goal to optimize Sharpe ratio, right, it is a good basis for the risk parity model that is used by hedge funds today. And in contrast, right, let's say maybe you have a poor basis of reasoning instead, right? So for example, maybe you say that the last 5 years, right, the average price return per month for whatever sector or ETF you're looking at, right, the average price return per month was 2%. Right? So every year you have about 24, right? And so if the average for this year is still under 2% a month, right? Maybe we are looking from the start of the year to date, right? Then we should buy because we are at a lower return than average. Right? Okay, so mathematically, this sounds like it makes some sense, but the truth is there's really no clear reason why the average monthly return should be 2%. Right? And when this is the case, we don't even need to go to backtesting. Right? In fact, if you do backtesting, you may find that, oh, actually it works, but your basis, your logical reasoning is not there. And therefore your quant model is not something that we want to rely on, right? And even have hedge funds, millions of dollars being poured into it is not something that is reliable enough. Right? So your basis of model reasoning, it is extremely important. Right? It must be very sensible, right? It must be analyzed by a human and deeply understood by a human. Okay? So this forms the foundation of any quant model. Right? So after we've established our goal, then we look for data. Okay, so here's the part where we answer the concern of how the past will not be so reflected to the future. Right? The data that is used is always carefully selected. Say, for instance, right, if you are running a model for the US technology sector, right, which of course we know today we have our big tech, right, Facebook, Microsoft, Amazon, right. So would it make sense for us to use data from before Facebook, right, Google, they were big enough, right, or they were at least decently big? Maybe if we use data before the first iPhone came out, right, and we are trying to see how Apple has a good impact, right, maybe Apple is a good position to have in your portfolio, and you're using data from before the mid-2000s, then that actually doesn't make sense at all, right? So many of the times, sometimes, we think that having more data is always good. But the truth is that's not always the case, right? If you're analyzing US technology, it'd be much better to take data from after the US big tech firms have become established. So your data has to be reasonably well representative of the future. Okay. And then we go to cross-validation, right? So this is where we really come and backtest our hypothesized model, right? So here's the thing about backtesting, right? Sometimes we think about backtesting this way. Say we have data from 2006 all the way to 2021, right? And we just test it and the result is good, and we say, okay, good to go, right? So let's just do this for October 2021, next month onwards. No, okay, no, this is not how backtesting is done. Backtesting is actually a very rigorous process by itself. So not only do we need to test the model across different timelines, right? We also need to test the model with different data from different scenarios where your base logic of the model still makes sense. Right? So for example, if we have data from 2006 to 2021, we need to first start with using data from say 2006 to 2015, right? And then we use it to test against the outcomes for 2015 to 2021. And after that, we are not done, right? We want to repeat this again. Now with data maybe from 2006 to 2012, right? And then from 2008 to 2014, right? And because the logic of risk to return ratio, it is a more general one, right? So if you think about it, this should not apply and work in your backtesting only for a US geographical sector, right? It should also work for other countries. It should also work for narrower sectors, right? Say, example, US healthcare, US tech, US financials, right? Or you can do it for China healthcare as well, right? It should work, right? If it doesn't work, there should be a reason behind it, and it is our responsibility to go and find out what is that reason. Okay. So only when all these are tested and proven, right, to work, can we say that that baseline of reasoning, right, it is something that we can have confidence in. Okay. So after this, then yes, we can establish that level of robustness in our model, and then we can say that we can finalize the coding, and at the end we have our strict action triggers, which are to give us clear actions. Right? We should not be adjusting the model much, if not at all, at this point. Right? So when should we adjust the model? Right? It is something that we are going to follow for maybe 3 years, 5 years, right? So when should we consider adjusting the model? Well, usually we would want to change the model and reflect on our model when our basis of reasoning weakens. Right? So say, for example, if your model logic is based on, again, let's use US tech again, right? Apple, Amazon, Facebook. Right? Let's say these companies, they are one day no longer the big giants that we know. Right? Maybe there's a shift, right? Maybe our US tech is more reliant on some other industry. All of a sudden, we don't know what, right? Maybe that whole notion of social media is going to change. Right? We don't know. Right? But what's happening here is that our basis of our model, right, it is actually weakening. So with no firm foundation, that is when we really need to look at our model again. We need to look at our logic, our reasoning again, and see whether we need to change some things. Okay. So this is how quant models work. Right? It is a very rigorous process that quants do go through in order to create their models, right? And rightfully so as well, as billions and billions of dollars are poured into quant investing via hedge funds, right? Where there really is only room for strong logic, strong reasoning behind every action taken. Okay. So with that, right, that's actually all we are going to cover today. When it comes to having success in our investments, we really do need to clarify our investment approach, right? So that we can prevent many things from possibly going wrong in our investment journey. Right? So I hope I've helped everyone gain more clarity when it comes to running investments within this 30 over minutes, right? And other than this, just to share as well that there are a few other areas every investor has to take note of in order to do well consistently. Right? So today we had a whole session just for this first segment on clarifying the approach. But for the rest of the sections, we're actually going to be able to cover all of them together on the 23rd, right? Where we'll be using all these topics to talk about how consistent profitability is achieved. Okay, so if you just sign up for this one session, right, do try to sign up for the other subsequent sessions as well if you can make it. I will be very happy to have you with us. Okay, so with that, it's time now for the quiz, right? Kevin, I do see that you have raised your hand multiple times, but if you do have any questions, please feel free to ask them in the Q&A chat box. Right? And if we are able to answer some of the questions, we are going to be very happy about it. And definitely, right, if we are not able to answer, let us also try to get back to you, right, via email or via some of the other subsequent webinars ahead. Okay, so now it's time for the quiz, right? Just to share everyone also, if you've been with us on the first and second session, you would know that our quiz, it is also for the lucky draw. So every single correct answer that you have is going to give you an added chance at the lucky draw, right? And the lucky draw is going to let you be able to have some CapitaLand vouchers, and if you win, you're also going to have that mega quant packages coming from all quant when it comes to learning about all their strategies. Okay, so let me just set up our quiz for now. Okay, so for those of you, right, who are not familiar with how to join the quiz, please just very simply scan the QR code, right, or you can go to ahaslides.com/PS8-4H. Okay, so let's wait a moment to let everyone join in. Anyway, the quiz is very simple. Okay, it's just for us to all recap on what we've been learning in this festival, right, in this session, and definitely, you know, we are very happy to see that all of you guys have been listening and paying attention well. I do see some of you guys maybe having some issue joining, right? Don't worry, let's wait for maybe another 30 seconds, half a minute, right? So that everyone can come in and participate. Okay, so we're going to start. So as mentioned, we are going to have just two very simple questions. Right? And then for each question, we have 60 seconds to answer. Okay, so ready, right? First, please provide the last four characters of your NRIC or passport number, right? If you're not from Singapore. And this is for us to actually give you your lucky draw award if you do manage to win. Okay. Okay. So please look at your phones. Right. Please join. Right. Remember to press the join button. Right. You don't want to have less time than needed when the questions start to pop up. Okay, so we're going to start. Right. Don't worry, the questions are very easy. Okay, so here we go. Right. First question. Right. When markets fall, if you are a quant investor, what should you do? Right. And if you are practicing fundamentals, what should you do? So this is actually a very, very crucial question that we need to ask ourselves. When we are running our investments for many, many years, we are going to have many of such situations. So how should we navigate the markets? Okay, 20 seconds left. I do hope we have at least one of our questions today having all the answers being correct, like we had. So for the last session, okay, 3 seconds. Okay, time's up. Right. Yes, right. The answer is watch out for portfolio action triggers. But if you are running quant investing, right, do also remember that a lot of times quant investing, right, it is based on the philosophy of using science and math to give you very clear action calls. Right? So if your model tells you to go and buy something or sell something, please follow your model. Right? And if it doesn't tell you to do anything, please don't do anything as well. Right? Please follow your model. Right? And definitely if you are running fundamentals, fundamentals in the first place, right, you would have already chosen a position to be in, to have the exposure, because fundamentally this company is sound, right? It is attractive. Right? So it doesn't mean that when markets fall, then that fundamentals is just a loss. Right? A lot of times actually your fundamentals are still there. Of course, there is the chance that things change, right? And maybe your company, that business prospect changes entirely. Yes, but more often than not, we should be looking to buy at a lower price. Okay, so that's for the first question. Let's move on to the second question. Okay. So why do markets keep going up in the long run? Is it because of inflation, right? Or is it because of something more real, right? More crucial, something that we really need to remember over time. Please look at your phones. The options they are on your phones, right? What is 1, 2, 3, and 4? Okay, 20 seconds. Okay, 5 seconds. All right. Please remember to press submit. Okay, time's up. All right. Wow, we have quite a mix of answers. Okay, the answer is 2 and 3. Okay, yes, inflation happens, but it is not really that core reason that we're looking for. Okay, we are always remembering how humans, we are always trying to work and have a better life. Right, that is the power of the human spirit. And at the same time, we are having a global population growth because of medical technology. And therefore, that increase in human population leads to greater consumption, greater production, and it leads to greater GDP, higher incomes, higher earnings for companies, and therefore higher share value over time. Okay, so thank you all for participating. Right, the winners for the lucky draw will be announced at the end of the festival. Okay. So thank you to you guys. It's time for the Q&A. So if you guys have any questions, please feel free to write them in that Q&A chat box. Okay. Let me just put up the Q&A slide. Okay, let me just quickly answer some of the questions. Okay, admin related question first. Okay, will the recordings be provided? Right. So far, we are trying to put them up, right? But we are seeing that we do need at least maybe 1 week to put up the rest of the recordings after the live sessions. Okay, so we have actually tried to rush out that recording for the first session. So if you want to see the recording of the first session, you can search for all quant, right? And it is actually put up on their website. But for the remainder of the sessions, right, we are trying to put them up. We might need to have more than 1 week timeline before they're actually up. Okay. Okay, let me answer some of the other questions on the topic at hand today. Right. Okay, one of the questions is asking, so how do we use target prices? Okay, let me just maybe jump back to the slide. Donna, okay, so the thing about target prices, right, is that a lot of times we are actually just focusing on one company. And then based on target price, of course, we have a certain percentage return potential. Okay, so how do we use target prices if we are not going to trade off that target price, right? If we are not going to say, okay, so here we are saying that Xiaomi can potentially reach Hong Kong dollar 38, right? 38 Hong Kong dollars, right? So when you reach that price, right, if we are not supposed to just sell it off, then what should we do, right? We should actually, firstly, right, number one, be looking at a new target price at the time when you have seen your stock or company reach that particular price. Okay, so let's say today we are saying that, okay, Xiaomi can reach this certain price, right? That's the valuation that we have in mind for today. Right? Maybe it takes 2 years to reach this price. Okay, so at the end of 2 years, right, we have to reevaluate again what is that price. Okay, so this is number one, right? That your target price can change over time. Right? Number two, right, should you be putting this stock in your portfolio, right? So this, we need to consider it always in relation to other target prices, right? Other approaches, other positions. Right? So for example, maybe you have let's say the renowned company in China now, Alibaba, right? And then with the recent China crackdown this year, right, the price has dropped a lot, and then maybe through the valuation, you say that, okay, Xiaomi, maybe it has a potential of 61, right, 61%, but you may think that, you know, based on that target price of Alibaba, maybe you say that it is actually higher than 61, okay? So this, right, would mean that actually you are going to have your allocation, right, a little bit less into Xiaomi, right, a little bit more into Alibaba, right, if this is your valuation, right? And let's use a more simple example, right? Let's say you have a target price that is very close to the current price. This doesn't mean that although your target price is actually higher than the current price, right, doesn't mean that you should buy, right? Because your return potential is so much lower compared to everything else. So in this scenario, maybe we shouldn't even consider this company in the portfolio at all. Okay, so target price, always use it in relation to other positions. Let's have a second question, right? So the second question is rigorous backtesting the reason why quant models can be used for the future? Okay, okay, I believe I covered this a little bit just now. Okay, so let me just jump to that pyramid again. Okay, so a lot of times, right, we are worried about backtesting. Why? Right, because we think that backtesting is the reason why quants think that it will work well continuously into the future. So please remember this, right? In quants, right, the reason for why your quant model should work going forward is not because of the backtesting saying so, right? Backtesting only supports the idea that your quant model is going to work going forward. It's not the reason why, right? And it's not to give you predictions of the future, right? So if you were here last session, Ingwen shared that if your backtesting cannot even work, right? If it doesn't work in the past, then why would it work in the future? So this is just a supportive reason why your quant model should work down the line, right? Why really, right? What really is the reason, right? The reason is your basis of model reason, right? It's this foundation over here, right? That tells you that, okay, your model, right, it really is based off logical sense, right? And this logical sense is going to be relevant, right? Not only in the past, it's going to be relevant in the future as well. It's going to be relevant, maybe we cannot say for sure 30 years down the line, right? But at least we can still be certain that it is very relevant 5 years ahead or 10 years ahead, okay? So this is your foundation of the model, and this is why your quant models are going to work down the line. Okay, right. So I'll be glad to answer more questions if you guys have more of them coming in. But yeah, so if we don't have any more questions coming in, right, or if you want to ask some of the questions privately, right, please do remember, right, to let us know. Right, you can always contact us. Our contacts are actually on our website. And yes, thank you for attending. Thank you for being with us. And on the 18th, this Saturday, we are going to talk about trading volatility. Right? So this is going to be a very exciting topic. Right? We are going to learn really how is volatility being used in quant investing. Right? How do we profit off volatility? During market downtimes, this is actually something that can give us a lot of benefits. Okay, so if you have not signed up, please do sign up for the session on the 18th, this Saturday. It's at 11 a.m. Right? And I look forward to seeing you there. Okay, so that's all for this session. Right? Have a wonderful evening, good night's sleep, right? And please enjoy the rest of the week ahead. Okay, so that's all. Thank you. All right, thank you for coming. Bye-bye.